This chart follows the S&P 500 to its 2009 low. Two investors face the exact same losses. By 2013, the market recovers. The investor who stayed in regained their wealth, while the investor who panic sold missed the entire recovery. Market drops are almost always temporary. Hitting the sell button, at the wrong moment, is what turns that drop into a permanent loss. Recessions are a normal, repeating part of how economies function. Since World War II, the average U.S. recession has lasted around 10 to 11 months. If these cycles are mathematically predictable, we have to look at why smart investors continue to make the wrong decisions at the worst possible time. Recency bias tricks us into believing the crisis happening right now is different and more dangerous than anything that came before it. In 2020, the story was a global pandemic and a physical shutdown. In 2000, it was the internet bubble. While the stories change, the underlying pattern remains the same. During the 2008 crash, the fear was that the banks were failing and the entire financial system was broken. When uncertainty is this high, the terror of the present moment overrides historical logic. The data shows something surprising. The stock market's best single days in history often happen during recessions, sometimes within the same week as the worst days. Uncertainty drives prices to swing hard in both directions. Panic selling causes the crashes, but any piece of good news can trigger an equal. The S&P 500 saw 2 of its 10 worst trading days and 2 of its 11 best days in the exact same month. Fleeing the market to avoid the pain of the present guarantees you will miss those subsequent rallies, destroying your chance at recovery. This leads to a second trap, waiting for good news before getting back in. The National Bureau of Economic Research, or NBER, is the group that officially calls a recession in the United States. Metrics like unemployment and GDP are backward-looking. They tell you what already happened. The NBER usually announces a recession months after it has already started, once they have enough data to be sure. The stock market and the economy operate on different timelines. The market is forward-looking. It is constantly pricing in what investors expect to happen months from now. Look at mid-March 2020. The S&P 500 dropped 30% in weeks, eventually bottoming out on March 23rd. One of the fastest recoveries in history began while unemployment was still climbing and lockdowns were spreading globally. The market reacts the moment the future outlook improves even slightly, often while the headlines are still terrible. If you wait for the lagging economy to produce good news, you are waiting until after the forward-looking market has already recovered. You cannot outpredict a system where the economy tells you yesterday, your panic reacts to today, and the market prices in tomorrow. Successful investors remove human psychology from the process entirely. They follow a predetermined, mechanical plan created during a state of calm, long before the crash occurs. Decide your emergency fund threshold, your automated contribution rules, and your rebalancing triggers today. Decide once while you are thinking clearly, so that you aren't forced to decide repeatedly while you are scared.